Realty Income stock ticker O is one of the most beloved dividend stocks by the investing community. They're known for paying monthly dividends, having some of the most stable properties in the world, and over time providing an amazing source of passive income for investors like you and me. But is Realty Income all sunshine and rainbows? You're going to have to keep watching to see if that's the case. Today we will be taking a deep dive into Realty Income's business model, financials, the dividend itself, and so much more to determine whether the talk is really the walk. And guys, I've done this challenge once and I'll do it again. For every like this video gets, I will be putting $1 into my Realty Income position right now. Go at it. With all that out of the way, roll the intro.
Hello, I like money.
To start off, I think we should obviously go over who/what is Realty Income. To start off, big thing about Realty Income, obviously it is a real estate company, which in the form of a stock is a REIT, which is a real estate investment trust. Everybody calls Realty Income the monthly dividend company, but they actually have it copyrighted, which is kind of funny yet cool at the same time. Realty Income, also known as the monthly dividend company, is an S&P 500 company and a member of the Dividend Aristocrats. Their goal is to deliver a dependable monthly dividend that increases over time. Now, I like the sound of that. They say that these dividends are supported with cash flow from long-term net lease agreements with over 12,400 real estate properties around the world. A big thing to note about these triple net lease agreements is that Realty Income does not have to take care of utilities and all that other stuff the tenant does. Big thing to keep in mind. This saves Realty Income a lot of time, energy, and money. So God forbid if one of Realty Income's buildings actually burned down or big damage happened to it, they would not be responsible for the damages. Realty Income was founded in 1969, and since then they've declared 636 common stock monthly dividends and increased their dividend 121 times. They say they continue to remain committed to that initial goal as they pave their way for the next 50 years of growth. Now, Realty Income has really embraced being that dividend company, but a big thing to keep in mind with these high-paying, high-yield dividend stocks that pay a lot in dividends, most of the time these companies are not the greatest investments, but I think there's an exception for O. As we dive deeper into their business later this video, we're going to see that Realty Income is a very strong REIT itself with a very high quality properties that will do well during tough times. Since their IPO in 1994, they have a 14.6% compound annual total return. That's very good, and that's actually outperforming the S&P 500 annually. Dividends are a huge part of that return as well. They have a 4.4% compound annual dividend growth rate on their dividends since 1994. That's alright, it's nothing to write home about. Keep in mind they have had a very high dividend yield in the past. They have declared and paid 636 monthly dividends, which is nuts. And they have over 12,400 long-term net lease agreements. Realty Income is a 99% occupancy rate in their portfolio, which is very, very impressive. So no matter what time of the year is, their properties are turning a profit, which is awesome to see. Their properties have over 1,259 different clients, which is huge to understand as well. They have a lot of diversification, and their tenants are in 84 separate industries, so more diversification amongst the tenancy, which is awesome. Realty Income also has very solid geographic diversification. They have properties in England, the UK, Ireland, the United States, a little bit of Canada, and Alaska. Realty Income says that relationships are the cornerstone of their business and that they're proud to partner with industry leaders across the globe like Treasury Wine Estates, Sainsbury's, 7-Eleven, Lowe's, and Chipotle. So if you think Chipotle is overpriced right now, this is some great way to get some diversification at Chipotle. Realty Income's portfolio consists of retail, industrial, and agricultural assets that generate stable cash flow and enables them to deliver consistent monthly dividends for shareholders. Realty Income's tenants are very high quality and mature companies that are very unlikely to go bankrupt and are very likely to pay their rent. Currently, Realty Income's portfolio includes high quality real estate in all 50 states along with Puerto Rico, the United Kingdom, Spain, Italy, etc. And they are continuing to look to geographically expand across the world. Tenant diversification is a big reason why a lot of shareholders and investors prefer Realty Income over maybe another REIT like Vici. The top 10 industries that Realty Income's tenants are in, starting off at 10.2%, are grocery stores, convenience stores, dollar stores, home improvement, quick service restaurants, drugstores, casual dining restaurants, health and fitness, so like gyms, automotive services, and general merchandise coming at 3.8%. These are essential tenants to society and essential industries to the world. These are industries that can't be really replaced, and really are just essentials for people across America. As we saw in 2020, God forbid another pandemic or something like that happen, I think Realty Income's in a fine spot with their tenants that they have. Another very impressive thing about Realty Income as well is their portfolio occupancy rate. We can see here basically since their IPO, their occupancy rate has really never dropped below 95%, which is awesome to see. Realty Income's tenants are slow and boring companies, which is what I love and what I would like to see from Realty Income's tenants. Realty Income's top 20 tenants coming in at number 1 are Dollar General, Walgreens, 7-Eleven, Dollar Tree, Wynn Resorts, FedEx, LA/Sport of Fitness, B&Q, Salisbury's, BJ's, CVS, Walmart, Lifetime Fitness, Tractor Supply, AMC Theaters, Red Lobster, Regal Cinemas, Tesco, Lowe's, and Kroger. These are all large, mature businesses that are very likely to pay their rent every month, and if they don't, it's very easy for Realty Income to find a new tenant. These properties are gold, they have very good locations on them. I would say the most risky tenants right now that they have, I would say Walgreens is definitely up there. They're closing stores right now, but again, these properties are very good locations, are in high demand at the same time. I would also say AMC Theaters long term, you could see some issues there as well. Same with Regal. The top 7 regions that currently Realty Income is in is Texas, the United Kingdom, California, Illinois, Florida, Massachusetts, and Ohio. I like to see them in growing markets like Texas and Florida. I think long term that will also really benefit them too. 82% of their properties are in retail, 13% in industrial, 2.8% in gaming, and other in 1.9%. Always also diversifying and getting some exposure to gaming and more experiential based real estate. Now let's dive into Realty Income Company itself and we'll go over the financials. Currently, Realty Income is trading at $59.87. Over the last 1 year, they're down 6.2%. They have a market cap of $40 billion, a price to sales ratio of 12.93. They have a very impressive free cash flow yield of 7.04%, and an even more impressive, very low stock based compensation impact of that free cash flow of 0.82%. They have very solid profit margins of 25.8% and an operating margin of 39.5%. Currently, they have $17.5 billion in debt and only $164 million in cash. For a company that's not a real estate company or doesn't use debt to leverage their business, real estate's one of those industries where you need to use money to make money, so they use a lot of debt to actually grow their business, so that's not a red flag for me. Currently, they have a dividend yield of 5.15%. We can see annually they have very quality revenue growth, solid EBITDA growth, great free cash flow growth, and their net income has gone up over time, so all positive financials so far. We can see that since their IPO, and really since ever 2009, they've had really large, stable, and consistent free cash flow growth. As of about April, their current free cash flow is $731 million. They have a 5-year free cash flow growth rate of 22.62% and a 10-year free cash flow growth rate of 16.04%. All very solid growth rates. We can see that Realty Income's earnings per share have really just been large and stagnant with not a whole lot of growth, 2-year growth rate of 1.5% and a 10-year growth rate near 4%. Currently, Realty Income's return on capital employed is 0.8%, obviously going to be slower for a more mature company like Realty Income and in an industry like real estate where the returns are pretty predictable. We could see, usually it trends up by 1.2%. Now moving on to the topic that I'm sure you all want me to talk about, which is the dividend. Currently, Realty Income pays a 26-cent annual dividend. This dividend is paid every month, and if you ask if that makes a difference, yes, it does. It's a very small difference if you do reinvest the dividend. But you guys know me, I like my dividends, but I also like them when they're sustainable too. Is Realty Income's dividend sustainable? For real estate companies, if you see an obnoxious payout ratio, like for I saw 220%, for example, you need to look deeper into it. You need to look at the FFO payout rate, forward payout ratio, which for Realty Income is 73.89%. Now, typically the payout ratios for real estate companies will be higher than your standard company at like 40-50%. Real estate companies will be at like 80, 90, 70% in this case. REITs are also obligated to pay like 90% of their earnings out in the form of dividends. Realty Income also does share dilution, which isn't great for most companies that I invest in, but there's a case for real estate companies. They need to obviously raise money, get leverage to buy new properties and grow their business. Now let's talk about Realty Income's valuation and what I would buy it at. And coming at you like Pippin and Jordan, we're of course going into Dividendology's dividend discount model. The dividend discount model is the value of the dividend divided by the cost of the equity capital minus the growth rate. Guys, Dividenology is like the godfather of, valuation, dividend YouTube, and he just hit 60K subscribers. I'll leave his channel in the description. Thank you so much for him allowing me to use this again. Go check out his channel in the description and his Patreon if you want to get access to this spreadsheet. So finding that, we have the average growth rate of 2.91%, the discount rate of 8%, and the growth rate currently of Realty Income at 3.75%. And the dividend discount model has Realty Income fairly priced at $74.55, way above the current $58 it's trading at. Keep in mind this video was made a few months ago when Realty Income was trading in the mid-60s. So if you apply a 10% margin of discount to the dividend discount model price per share of $74.55, so let's just discount that fair price per share of 74.55 and you get a fair price of roughly $67, indicating to me that Realty Income could potentially be undervalued right now. Well, let's take a deeper dive. Currently, Realty Income's price to FFO ratio is 14.37 compared to the sector median of 12.91. So that could indicate that Realty Income is overvalued right now, but let's see what analysts have a current price on it. Currently, 5 analysts have Realty Income as a strong buy right now, with an average price of an acceptable buy of $70.45, which is a 17% upside right now. The highest price target on Realty Income is $74 per share, and the lowest price target is $68 per share. So where would I buy Realty Income? Currently, I have Realty Income at a buy right now, and I have it at an acceptable fair price at around $68 per share. I don't think Realty Income is an amazing dividend growth stock, but at the same time, it is a very high quality and mature business, which I, as a dividend investor, I just love. Now, here's my bull and bear thesis long term of Realty Income. First off, the big thing I think with Realty Income is they just need to keep doing what they're doing. What they have been doing clearly has been working. Try not to get too fancy or whatever, just stay what has been working, keep buying those high quality properties, and keep finding essential businesses to be your tenants. I would also say keep dipping your toes and expanding into experiential based real estate. Obviously, gambling. They also have some properties in Massachusetts like that. Kind of going off the back of that, they got to keep diversifying as well. I'd like to see them get that retail number a little down because obviously a lot of people are not bullish on retail right now. But I do think long term retail will be a great company and great tenants to have. Also, this is going to be unpopular, but slowly pull out of the companies that like Walgreens that are closing stores right now. I would slowly pull out of those companies. Monitor tenants that are doing poor financially and that aren't really churning a profit. And also then make sure your real estate keeps appreciating. They're doing this with high quality properties in high demand areas. My bear thesis I think is very unlikely to happen, which is obviously retail dies. Some people think that, but I think retail will be fine long term. Store closures actually, impact them and their occupancy rates. If Walgreens keeps closing a lot of stores, they'll negatively impact O. But again, those properties are in great areas, high demand on them. I don't see them really losing long term on that. If there's a recession or real estate crash, that's obviously going to impact them in the short term slash medium. If another pandemic happens, that's obviously probably going to impact them. Even though looking at 2020, they still had pretty good occupancy rates and it really didn't impact them much financially. And lastly, their low quality tenants don't pay rent and they end up losing money on that. But overall, at the end of the day, whether you're young or old, I think Realty Income is an amazing stock to own regardless of your age. For me, I'm obviously more dividend growth focused, but I do still own a little bit and a good amount of Realty Income. You aren't going to be seeing crazy growth, but that dividend definitely is sustainable, and long term, this will be an amazing company to own, in my opinion. Let me know in the comment section, what are your thoughts on Realty Income? Are you buying? Did you sell out? I would love to hear. If you appreciate that I made this video, if I'm personally speaking, I think it's the highest quality video that I've ever made so far. Hit that subscribe button for me and smash the like button. If you want to go to the extra mile, share the video with somebody. Join the Discord link in the description, and of course, do dividend stocks, not drugs. Have a good one.